Okay, let's talk about becoming a corporation. So first of all, why would we want to be a corporation instead of a proprietorship? One of the main reasons is that if we're a corporation, we can issue stock, which means that we can have investors invest in our company. We give them ownership and they give us money. So that is issuing stock and having investors. Another reason is that it offers us limited liability, which means that if somebody sues our company, they cannot come after our personal assets, so we have limited liability. So why wouldn't everybody want to become a corporation? Well, first of all, it requires more paperwork and it has more rules to follow. It has to have a board of directors, it has to have meetings and that sort of thing. Also, it is subject to double taxation. So if you have dividends, those dividends will be double taxed. They'll be taxed at both the corporate level, and then they'll be taxed again at the personal shareholders level. So those are a couple of the negatives of becoming a corporation. But let's say that we do want to become a corporation. What would we do? First of all, we'd have to have a document called the Articles of Incorporation. And inside this Articles of Incorporation, this one is Apple's restated one, it's going to give out information. It's going to tell us the name of the corporation, and it's also going to tell us how many shares of stock we authorize for this company. So here we have Apple's. We've got the number of shares of common stock which this corporation is authorized to issue is 1,800,000,000. And then they have a second class of stock called preferred stock, and it's authorized to issue 5,000,000. We'll be talking about both of those types of stock in this chapter. To become a Mississippi corporation, you would then go to the Mississippi Secretary of State and you would complete the Articles of Incorporation by completing this form. It asks you for the type of corporation, which would be profit, and then it asks you about the number of shares that are authorized to be issued for stock, and then some of the other information, and then you pay a $50 fee and you will become an incorporated or become a corporation. So let's talk about stock. One of the main transactions that we'll be accounting for in this chapter are stock transactions. So when we issue stock, we are giving away our ownership and receiving money from investors. So when we look at a stock price, I've pulled it up on the screen right here of Apple, we are actually looking at the market price. So once the company issues the stock, they've gotten the money from the investors. That's the last time they are directly going to make a journal entry for the stock. So in other words, when Apple issues stock, they're going to have cash go up, they're going to have common stock go up. Then from there, whoever owns that stock can trade it freely in the open market. So it is easy to transfer ownership in stock because you can sell a share of stock anytime you want. Apple does not have any say-so in who buys it after they first sell it to you. So when I'm looking at this stock price right here, currently Apple's selling at $108 per share. It is down 63 cents today. The whole entire market is down a little bit today. It goes up and down, it fluctuates. But there's lots of information here. So if you look through here, I can come to this point right here and I can see that we had a stock split. Let's talk about what that means. Later on in this chapter, you're going to talk about how to make a journal entry for a stock split, but right now let's just talk about what it means for us reading a stock chart like this. So what happened is Apple got up to $700 or $800 a share, which was a high price, and they were thinking that somebody may not be able to afford to buy one share of stock, or they might not want to put that much money into one share of stock. So what Apple can do is split their stock. And what that does is on the day of the split, it halves the market price and doubles the number of shares. So it automatically knocks down their stock price, but your investor has the exact same amount because now they just have double the number of shares but half the price. So that's what a stock split is, and that's what you see here. The other thing that you're seeing throughout here are dividends. So when we buy a share of Apple, we're buying it for a couple reasons. One, we hope that the stock price goes up and we can maybe later sell it at a gain. But another reason that we may choose to do this is because each quarter they may provide us a dividend. So they may decide to declare a dividend, which means that they will actually distribute some of their earnings to us as shareholders. So you can look through there and see what their dividend is. So it looks like their current dividend is 57 cents per share. So for every share of stock that you have, you will receive 57 cents a quarter. Now this is something that they can decide to do or decide not to do. They're not required to pay a dividend, but each time they declare a dividend, they will pay 57 cents per share to their investors, and we're going to learn how to account for those. Each time you see this D, that is a dividend payment, and you can see how much per share it was. And if we went back even further, you'd actually see that for a long time, they did not pay a dividend. Apple was actually holding on to their earnings and not distributing them out. Instead, they were using all their money for growth and for research and development. And then after a while, after they accumulated a lot of capital, then they started paying out dividends to their investors. So in this chapter, we're going to be studying corporations, and we're going to be studying what the journal entries are to account for issuing stock, paying dividends, buying back our own company stocks, and having stock splits. Let me know if you have any questions.